Well, investors have been taken on a roller coaster ride over the last 2 weeks. Will the volatility in the markets continue, or is something more ominous or even better coming our way? Let's find out. Joining us from marketgauge is Mish Snyder. Mish, let's take it from the top. As you look at the major indexes and the breakdown that we've seen since probably mid-February, what's your take on stocks here?
Well, first of all, hello, Jim. It's great to be with you again. We're old pals by this point. Well, essentially, this is a market that obviously was already starting to show issues before the tariffs were kind of nailing the coffin. Because if you go back to look at the beginning of the year and you look at the consumer, and you look at particularly the ETF for the consumer, which I like to use, which is XRT, because it does that blend of consumer staples and consumer discretionary. That flashed warning like right out of the gate of this year. And so coming in with a highly bullish feeling for whatever the reasons were that people had bullish feelings, I thought was a little bit misplaced because of that. So I still think that we have to watch the consumer very carefully, even now that we're in April, as a dictator of what happens with the SPY, the Qs, the Russells, and some of the other inside sectors, particularly the transportation, the regional banks, all of that, because if we don't have the consumer on board, as we know, 70% of the GDP. Tourism is also getting hit, which is part of the consumer market. That's 9% of the GDP tourism. It's going to be really hard to sustain any rally without the consumer involved. And how will we know if we're going to recession, just staying in stagflation, or going into more of a hyperinflation? That XRT is holding a critical, and I mean critical, line in the sand right now, which is the 80-month moving average that represents a 6 to 8 year business cycle. It's already contracted under a 2-year business cycle when it was doing well. So we're already in contraction. We see that. That's obvious. But the 80-month moving average has not been broken except for once, and that was the brief trip in COVID, which would tell us if that does break and it cannot come back, that all these calls for recession will start to resonate even greater. And then, of course, you have to change your game plan. What do you do during a recession? What type of stocks do you buy, if any?
Yeah, because it's not just consumer uncertainty, but there's a lot of uncertainty with business. What do? You don't know where like we're looking at some stocks, and I have a tech stock I want to buy, but 30% of their production is in China. So, a little bit leery of getting into a stock like that when it looks like it's outright economic war with China right now.
Absolutely. And that's exactly what I'm saying, is that you really have to think very carefully. And of course, we also know, as we saw when we had that huge flush on April 9th, hardly anything is safe when that happens. Even gold, that everybody's loving. And of course, you and I have been talking about gold since as long as we've known each other. Even that falls on high liquidity days because you get the margin calls, and people have to raise funds. Otherwise, they get forcibly liquidated. So, the whole thing is very, very tricky. And the safety plays are starting to also shift, although gold is still phenomenal. We're starting to see a little bit of movement here in these long bonds. That's the other thing I've been watching very carefully. We actually established a position in the TLTs earlier in the week, and I'm looking at it right now as we're speaking. And if they can get through, TLTs can get through like 89, it shows a real potential for those to soar, which means yields drop, but not necessarily good news. It could be another warning of recession coming. So I think that whether it's tariffs or whatever, it's going to be difficult to find safety on the board if all of this takes place.
Financial Sense Wealth Management has been ranked as one of the top registered investment advisors in the U.S. by the Financial Times. Give us a call at 888-486-3939 or visit us on our website, financialsensewealth.com.
Well, let's talk about one of our favorite asset classes, which is commodities. And you're looking on the day you and I are speaking, gold is up over $100. It's over 3,300. You've got silver close to over 33 right now. Where do you think we go from here? We even have people like Ed Yardini that's talking about gold may hit 4,000. And, Yardini's not known as a gold bug.
No, and Yardini was very bullish coming into this year, by the way. Changed his mind. I saw some of his representatives more recently, but so that's interesting. I don't know if that necessarily means anything in terms of predictions, but I can say this. Gold, obviously, we had looked at 2,800. You and I talked about 3,000, and then what happens next? 3,400 was another next kind of goal. Well, now we're not even that far away. I mean, we have to look at it in tranches right now, but what interests me more than that is the silver to gold ratio, because if we really want to be commodity based, we have to know. I'm going to go back to that same conversation we just had about the long bonds and about the consumer, and of course, businesses reflecting the consumer. Are we going into a recession? And that's where this gold silver ratio comes into play, because gold went up almost close to 103 in terms of its ratio to silver, which means 103 times the price of silver. As we're speaking, it's at 101.38. So people keep saying, oh my God, silver's so cheap, silver's so cheap, silver's so cheap relative to gold. And clearly that's historically true. But it's irrelevant if we go into a recession, because what will happen is maybe that ratio will come in, but it's because gold will fall even faster than silver. And that's what I'm kind of concerned about getting long up here. I think you have to watch silver. If that ratio starts to break down, say under 99, maybe we can say, it's peaked. Silver is going to go up relative to gold, and that would be more stagflationary. I'm not ready to rule on inflation right now, because I've seen too many instruments that I watch giving me wonky signals. Gold ratio to silver 1. Well, dollar's weak. That's certainly something that's concerning. And then sugar, which has always been my barometer, actually right now is not really performing impressively. It's down at around 17.5 cents a pound, which if that breaks means it could go lower as well.
Yeah, one of the things that I think investors have to remember, and this gets back to where the economy's heading, is 70% of consumption of silver is industrial.
Exactly. And that's why it's such a great indicator, barometer, for whether or not we're heading to recession. I mean, I did not think we were headed to recession up until the last week or so. And I thought one of the holdouts, of course, in terms of risk, was the fact that the long bonds were holding steady. But now, again, as we're talking right now, I mean, it was trading at 88.48. Now it's at 88.36. There was a little bit of a knee-jerk reaction here after Powell's speak this morning, because he's still talking about not really doing anything for the market. And many people don't think he can even save the market at this point. But the bigger problem is if he starts talking about lowering rates, that I think this message to the market is even the Fed has given up, and now they're worried about recession.
If any of you are confused about what's happening in the markets right now, feel free to reach out to us at Financial Sense. We've been in business for nearly 4 decades, helping high net worth clients achieve their financial goals with comprehensive financial planning and asset management. Give us a call at 888-486-3939 or leave us a message at financialsensewealth.com. I can't think of, Mish, a year where policy has played such a key in determining what's happening with investments. I mean, we have a 3-legged stool that we use. We look at fundamentals, technicals, and politicals, and this is a year where politicals are dominating the market.
And yet, and I know you and I have talked about this as well, we always tell people, don't trade with your politics. Which I think more means is if, depending on what side of the fence you're on, or I think a lot of people are sitting in the middle right now, I know this is going to work because I'm a Republican, or I know this is going to work because I'm a Democrat. That's what I mean. What you're really talking about is trying to trade off the political statements. And yes, they've been fast and furious and confusing and gyrating. And of course, we're seeing it in the VIX with a lot of fear. But actually, I have to tell you, Jim, if I focus on the charts, it kind of tells me even before the news comes out. So like, here's a perfect example. And this is a way for people to find some clarity, to find some relaxation, if you will, in terms of the stress that they're feeling. It's like I wrote an article just yesterday being April 15th, about the MAGs, the ETF that represents the MAG 7, because I noticed that it went into a death cross, which for those people who don't know means the 50 finally crossed below the 200, puts it in a bear phase, even though it's been negative phases. This is an official bear phase. I use a different parameter than just 20% drop. Anyway, I saw that happening. I saw the price was trying to bounce, but it didn't have a clean, what we call a clean reversal pattern. And so I kind of wrote, are you worried about MAGs? You should be. And then whammo, we wake up this morning to the 245% tariffs and NVIDIA with the blocking of the chips, the H20 chips, and all of the rest that came out. So there you go. Do I look like a genius because I could predict that something was going to come up with NVIDIA? Or did the charts tell me, you know what, this is definitely not out of the woods?
That's, for almost 2 years, the MAG 7 drove the S&P. And of course, the reverse of that, as money comes out of the S&P, the MAG 7 get hit harder because they're so cap weighted in that index.
Exactly. And there were even people that were suggesting when you get the people on the media constantly saying, keep buying, particularly NVIDIA, that NVIDIA was really the MAG 1. So, I mean, I certainly don't mean to laugh, but I have tried so hard this year, Jim, to do my part, to get on any media that will have me. And I've had a pretty good presence this year to tell people, don't listen to that. Don't listen to the generational buy opportunity. Yeah, we all know AI is the future. We know that. But that doesn't mean that A, markets aren't cyclical, and B, things got a little overvalued, and then finally, that news would overrule whatever the future is in terms of the valuation of the stock price itself and force people to liquidate. Please don't buy the dip until it's obvious things have settled. And I'm still hearing people say, buy the dip, buy the dip, buy the dip, buy the dip. So yeah, what we need is a rotation from tech not to fall apart any further, although I'm not sure that's not going to happen, rotation into some other areas to show that at least there's some optimism that we are reshoring, that we are going to do better in this country because businesses are going to invest here and they're going to have jobs here, and made in America is going to ultimately not be so expensive, and we don't need all these other countries. That's what they're trying to sell us here. But we need to see that in the price of the market. And I'm seeing that in very few places right now, not enough to be convincing.
Well, the other thing too about reshoring, I mean, if you want to, you've heard all the announcements, whether it's Apple, 500 billion investment here, it takes time to build a factory. And unless you get rid of the regulations that make it difficult to start a factory, or, create some kind of tax incentives to follow through, it may take a longer time. The other thing that really struck me, Mish, is a lot of the equipment that we would need to put into a factory, to build a factory, comes from China.
Yes, again, another one of those laughs. I don't mean to laugh, but yes, absolutely. I mean, and here's another thing, and I get this freedom when I talk to you, so I like to say these sort of things because I think people need to understand this battle that we're having with China and that we expect China to fold. If you look at the history of both of our countries, China pulled itself out of poverty. They had a tremendous poverty problem, and that basically was eradicated over the last 20 years. And now China has a strong middle class. That's not to say there isn't problems, but just from the general macro backdrop, China knows how to be poor, has pulled itself out of poverty because of its industriousness. Whether or not you want to argue that it underpays and, monetary issues, that's not the point. The point is over the philosophy. Whereas this country, in direct contrast, has done nothing but be prosperous and has a lot of sense of entitlement. And we have such a sense of entitlement here that we have expected all these countries to pay their workers basically bare bones minimum and send the stuff here so we could buy it cheaper and continue our wonderful lifestyle. And that's a dangerous game that I think is being played right now, is that we're anticipating that China's going to fold when it really could be us that hurts a lot more because of exactly what you said. We depend on China maybe more than they depend on us.
Yeah, I mean, the idea is we have the largest consumer market in the world, so therefore we're holding the cards. But all the things that we're kind of trying to do, whether it's build new factories, and let's talk about commodities, because when you're talking about bringing factories back to the U.S., factories need raw materials to make things.
Mm-hmm.
So let's talk about commodities, because you also have to have access to these commodities if you're going to start producing again.
Exactly. Well, so if we're looking at the metals here, I mean, obviously we've talked about silver. So silver's big breakout would be over 35. We haven't gotten there yet. And what we can see, of course, is the flight to safety is still going on with gold. So the industrial demand hasn't shown up. Copper, though, even though it's come off from the highs, is still, as long as it holds above 420 or 440, if you're looking at the May contract, that shows a pretty strong demand for copper. Platinum has been trying to go up here. Even aluminum is rallying a little bit today. These are steel would be another one. I mean, yes, we have to keep an eye on those. You can look at that through the individual commodities. If you're more financially oriented with ETFs, you can look at it through XME, which is, by the way, still very much in a bearish phase, just so you know. So that's why I'm saying, on paper, we could say that this is going to be very bullish for these metals and mining materials that we need. And of course, we can take a look at lumber too, but we're not really seeing it reflected yet in the charts. And so again, you want to see whether or not that's going to stress out our raw material with supply chain and all the rest. Watch those charts, and I'm still not ready, like I say, to go, I'm madly bullish. What is looking better, of course, is grain. Now, that has nothing to do with factories, as you mentioned, but, there's been an interesting pop in DBA, which is a lot of the soft commodities and a lot of the grain commodities. That's actually looking a bit stronger.
Usually when you go through these cycles and you go through these downturns, when you come out of it, you see a change of leadership many times. Like when we came out of the 22 period where stocks were down 25, 30%, technology stocks just went through the roof. The Mag 7 took off. Do you see any change in leadership in the sectors you're watching right now that might give you maybe an indicator that a change could be afoot?
Well, yeah, I mean, definitely if you look at, oil got really beat up in oil services, but certainly that might be something interesting to watch. Well, we did see obviously healthcare being very strong this year, consumer staples being very strong this year. And so, those have definitely taken charge. So you have to say energy, which was beat up, looks better, and healthcare, which was beat up, looks better. But, in terms of the leadership, if you're looking at the indices, the Dow is probably because of the defense sector and the industrials are showing some leadership. But nothing is as glaring as what we saw for 2 years when tech was just like, okay, all you had to do was grab onto the tails and be strung along to make a lot of money in the area of tech and basically ignore everything else. I'm not really seeing that so much that I'd be that confident in leadership of anything right now.
What about nat gas? The thing that really strikes me with all these AI centers, data centers that are going up, to power them, you're going to need electricity. And the only thing that seems to be working is natural gas, because I think you're years away from having nuclear play a role in powering these centers. What's your take on utilities and natural gas here?
Well, let me just mention something about clean energy. I actually did buy uranium, URA, a couple of dollars lower, like $3 lower when the market looked like it was basing. And I did that strategically because I saw, Well, not only is that an instrument that if you buy strength, you wind up getting murdered, because that's happened to me. Well, I wouldn't murder, but you get hurt. That happened to me a couple of times, thinking, oh, look at that, uranium's running away. So I figured, let me try weakness. But I do feel, even with the Middle East situation in Iran and et cetera, that maybe at some point cooler heads will say, you know what, let's stop this dependency on oil and natural gas, and let's look more clean. But since you asked me specifically about natural gas, I can tell you that it looks like when it got down to around $2, it kind of bottomed out. But it's another one that I'm not seeing anything yet that's going to make me convinced that we can get into a big natural gas bull market. I mean, maybe if it gets over $5, but right now it went from 2 to 5, and now it's trading at around 324. It's basing potentially, let's put it that way. Instead of topping, it could be basing, but we haven't seen the breakout yet. You need to wait for the actual breakout before you get too excited about that. As far as utilities go, again, that was another one that had a beautiful move last year because of all of the stories that came out about the demands from AI and data centers. And even though that's doing better than a lot of other instruments, so it has, you could say, some leadership, that too obviously got a little bit of hit because of just the overall liquidity issues. So maybe if utilities can get back up, if you're looking at XLU over 78 to 80, again, we'll see a departure. But for right now, leadership doesn't necessarily mean great buy opportunity.
So if you were to put some money to work, anything look attractive to you right now?
Interestingly enough, and I don't know if we've talked about this very much, but I really like Bitcoin. I mean, Bitcoin, again, has fallen, clearly. But if you look at the flush that we had in early April in many instruments, and you look at the flush of Bitcoin in April and where it is now versus, let's say, the MAGs, which is actually hit coming back to the lows of where it broke down from in April, Bitcoin's holding pretty good. It's sort of dancing here on the 50-day moving average. If you're looking at BTC USD, it's trading above 84,000. If we can get a good couple of closes over 85,000, there's no reason why it can't get back over that 200 and possibly start to see moves back up closer to 95.
It's amazing. We've spent probably, since you and I have been talking, we were talking about tech, we were talking about the Mag 7, but if you look at probably the last 12 months, I mean, take a look at gold, silver, and Bitcoin. I mean, they've been superstars.
Yes, exactly right. And, and we can come up with theories on this, right? So number one theory, of course, would be look at the dollar. I mean, the dollar is under 100. And even though some of the other fiat currencies have done better now relative to the dollar, you have to say, what's the future of fiat currency here? And is Bitcoin now finally going to find its place in the U.S. and global economies? Is that what we're seeing right now? I would find that extremely exciting, number one. And number two is most likely would be very alienating to most investors who are older because they still don't understand what the heck it does and why it even has any store of value.
It's hard to believe that, a decade ago it was $10, and now look at it.
Exactly. I mean, so if you want to know what I'm like, if you look at recession-proof type areas, Chewy, believe it or not, is something that's above the 50-day moving average. If you look around the board and to see what is actually trading in a bullish phase, you kind of don't find very much right now. Especially in the CrowdStrike in the tech world, but not that I would necessarily get involved with that. Bitcoin is one of the few things that I like. I did buy Symbotic because of the robotics and the AI in terms of warehousing efficiency in the US. But if the market goes down, that's going to go down. That's more speculative. That's more of a trade than an investment. Like I said, uranium, I won't take a loss in it, but we've got a little bit of a cushion that could separate from things. As far as my vanity trade, I thought things like Ulta would be somewhat recession-proof, elf beauty and things like that. What I'm seeing, though, is that real trend of the diet drugs leading into a new brand of consumer is having trouble because of the lack of consumer confidence. And I think we have to continue to look at emerging markets. I mean, China's down, but if you look at the China chart versus the SPY, FXI, that came out of a huge base and has basically retraced to support, while SPY has rolled over now and can't seem to get any footing. So I wouldn't dismiss some foreign equity markets as well.
Yeah, I was going to say the European stock market has done very well this year.
Exactly. And there are a lot of investors who have been getting involved with that. By the way, do you remember you and I talked about the Swiss franc last year?
Oh, yeah.
Well, FXF is trading at 108.82, and you and I talked, it was trading at 96. Now, that may not excite people who have seen things go nuts, but that's pretty exciting to somebody like me because that's a slow-moving currency. And I kind of saw it before that fiat, not only fiat currency in the US dollar is at risk, but that's tied to gold. That meant that gold was going to continue to go up as well.
Well, I tell you, we've been a big proponent of commodities, both of us, over the years, and I see a lot of potential down the road. But I think given all the uncertainty, a lot of things that are going on geopolitically, domestically, you've got to have some kind of a dollar hedge or an inflation hedge, and what better than precious metals?
Exactly. Exactly right. But again, just be careful with the silver gold ratio. That's why, because it's a nuance. It was trading at 85 for a while and then shot up with this recent move in gold. So if I still think we could easily go into hyperinflation. And what people don't understand is that you can have recession and hyperinflation at the same time. It doesn't necessarily mean a death sentence to every commodity, but I'd like to see just a little bit more evidence of that when we're looking around the board, whether we're looking at copper and silver or looking at the food commodities and the grains, the steel market, the oil market. If it continues to hold up here and starts to do better in terms of its departure from the overall equity markets, then I think that we'll see that silver gold ratio come down as maybe the first real sign that inflation is starting to rip.
So in summing up, I would say right now, Mish, you're somewhat cautious.
Yes, I mean, that doesn't mean like I'm cautious in that I'm certainly going to try to protect people from doing dumb things, like thinking that, stocks only go in one direction up, especially when you're talking about tech stocks. Doesn't mean it won't come back. But we know after so many years of a run outperforming growth with value outperforming, you've got to wait. So that's really where I'm most cautious. In terms of, I'm not as cautious in Bitcoin. And as far as other stocks that we have besides uranium, I think if you look, and Symbiotic, if you're looking at things that are in the U.S., that are getting supported in the U.S., maybe even some of the car manufacturers, even though they got beat up, we see that Trump is trying to say, hey, maybe I'll support you, although we don't really know. I think you just have to really be very careful. Watch those food commodities too, by the way. And just instead of being concentrated where you were concentrated, diversify a little bit into maybe some of these commodities, some of these emerging markets, and really keep your eye on the long bonds too, because the long bonds are going to tell you a story.
Oh, absolutely. Well, listen, Mish, as we close, why don't you let our listeners know how they could follow you?
Well, I'm very active on X, and that's at Market Minute. I answer everybody's questions. We have a website, marketgauge.com, where I post my daily blog, which is really meant to point things out, a lot of things we just talked about. I also now am on Substack, and of course, LinkedIn and Instagram and Facebook. I mean, I always like to say when you and I are closing our show, it's hard not to find me.
You're ubiquitous. You're everywhere.
Exactly.
Well, listen, my friend, great speaking with you again, and you have yourself a great holiday weekend.
Yes, same to you. Same to you. I look forward to our next conversation.